This is the Money Seed Podcast, where we discuss all things investing, plain and simple, the way it should be. Please remember, this show is for educational and entertainment purposes only and is not intended to be investment advice. He's Chris Ferguson. I'm Gabriel Stvory. Welcome back to the Money Seed Podcast. Chris, how are you today?
I'm great. How are you, Gabe?
Fantastic. Glad to be here.
Yeah, it's a fascinating week. So just to recap the last episodes, we talked a lot about why we're investing. You talked about why you're investing. So today I'll give some more history on why, or details as to my motivations for investing. And then I think you're going to give some interesting numbers as to how investing works based on your thoughts. And for anyone that doesn't know, so Gabe has an MBA, so he has formal training in business.
Yeah, thanks, Chris. That's the plan here. Is I'll just go through some basic math, some basic numbers, and to see what drives an investment, what drives value. But first off, I mean, on the previous episode, Chris, we didn't really get into your personal goals and why do you invest? You know, as an outsider, I could easily say, Chris, you have an amazing life. You're doing really well. You probably are one of those Americans that really doesn't need to invest.
So it's kind of a misnomer. So thinking that certain professions, like you can make money, but I only make money when I'm actively working. If I stop working, I stop making any money. And you can put money in a bank, but then it just slowly erodes over time. So just the theory of I'm just going to squirrel all my money away into my bank account and hope that when I retire, it's enough. I'd have to work incredibly hard to do that. The other thing is there's always that risk that something will happen and I will no longer be able to work. So I do have a disability insurance policy, but it's not a huge policy. And I have little kids and I want to provide for them. I have a wife that I want to provide for as well. And if I stop working, then that becomes a problem because then we have to like really change our entire life. And then there's the classic, put your money in a 401k plan. There's also the plan of there are these basically a 401k plan that you can put money in to send your kids to college. But I've spoken to a lot of physicians specifically who followed that plan. And sometimes if the market isn't where you want it to be, your entire plan then goes out the window. You can't retire and you can't do the things you want to do. Whereas I personally know a lot of people who've done very well, who started really with nothing. They started with like $5,000 in their bank account, no formal training. And either they did it in some sort of business or they invested in real estate or something along those lines. And they were financially set within sometimes 5 to 10 years of their business venture. So the position I'm in is I make a good enough living where I can afford to take risks in business. And if they go south, it's not like my entire life will be turned upside down about it. So there's a huge upside to investing. And other than losing some money, there isn't a huge downside.
Yeah, very well said. And that's a big part of it, right? Is you never want to invest more than you can lose, right? And you just said, other than losing a little bit of money, and the word little bit is probably key, right? You take a little bit of money that you're comfortable with. If there's a negative outcome, if I lose that money, it's not going to adversely affect my life. I can risk it, and you let it do its thing. And
it's kind of a classic thing. Warren Buffett said you should, the first rule of business is don't lose money. But things go south and sometimes you do lose money. So if you're going to take a bet, it shouldn't be a bet that will completely cripple you and force you into bankruptcy. So you take these little calculated bets on, I think the term is asymmetrical bets. You make a little bet with the potential for a huge upside with minimal risk, or even if it doesn't work out and you lose the money, you're not financially ruined by it. And that's my investing philosophy.
Yeah. And you know what? Second to that, you never want to risk more. You never want to invest more than you can afford to lose. You always hear these stories on the internet of young kids in their 20s maxing out their credit cards to buy like cryptocurrencies or something, some super risky investment. And you know what? If it works out for them, great. They'll have a fantastic party as they blow that money. But I mean, if it doesn't work out, they're going to be in a herd of just a heap of trouble.
Well, and I think there's also a selection bias. There are a lot of people that you'll hear about who've made these crazy bets, meaning they've mortgaged their house and they've invested in some sort of business, but you only hear about the successes. No one really talks about how they took this huge risk and then it failed. Like you just don't hear those stories because no one talks about it. And if you did that, like you usually don't go broadcasting how you completely turned your life upside down. Again, I personally know people who've taken very, very large bets that they really shouldn't have taken because they couldn't afford it on businesses or real estate or stocks or what have you. And it prevented them from retiring, or it caused significant financial stress on them, causing marital issues, et cetera.
Yep, absolutely. Absolutely. And you always want to be in a position where you don't have to risk more than you're comfortable risking. You know, some people find themselves in a difficult position due to some circumstance that's beyond their control. But as long as you're in full control, you definitely want to limit your risk. Never invest more than you can lose. So I completely agree with that. So let's talk a little bit more about money. And everyone's circumstances are different. Everyone's needs, whether it's retirement or whether it's pursuing their dreams or whatever. But let's just talk about the figure 1 million for a second. And it's a nice round number, so it's easy to talk about. It's also, most people can conceptualize how much money that is. It's a lot of money. But one of the reasons why I like to think in terms of like 1 million or 2 million, because if you look at $1 million, let's say you have $1 million right now in an investment that's somewhat liquid, right? Stock market, or in a real estate portfolio where you can relatively easily sell one of the properties. And the idea being that you can take some money out of that relatively easily. That's what I mean by fairly liquid. And if you have $1 million in that portfolio, and that portfolio is in a conservative sort of growth stage where it's getting, let's say, 7% a year, that means, in theory, you could take out 7% of that portfolio every year and never lose, like that portfolio will never go down. So you start with $1 million on January 1st. It appreciates 7% during the year. So at the end of the year, it's 1,070,000. You take out the 70,000. You have $70,000 in your bank. That's your money. And then your investment is back to $1 million on January 1st the next year. So you can take out $70,000 every single year forever, right? It's theoretical, but the numbers work out that way. And I say 70,000 because most Americans who have a full-time job, who go to work, that's kind of like the median salary in America, right? For a full-time employee, somewhere around 60,000, 70,000 a year. And most people, if they live in a smaller town or somewhere where their living expenses are already paid off, or maybe their home is paid off or something, and they're not saddled with a huge rent, they can live relatively comfortably on $70,000 a year. Yes, you got to pay a little bit in taxes to the government and blah, blah, blah. But if you have $1 million in a liquid account, like a liquid investment portfolio, you can take out, in theory, that's 70,000 every year and live relatively well. Now, some people will say, my living standards are higher, so I want to take out 140,000 a year. Okay, well, then you need $2 million, right, in that kind of an investment portfolio. And so that's why, if we talk about the value of 1 million for a little bit, let's talk about how do you get to 1 million, right? And there's two ways to get there. One is you start putting in a lot of money every single year, or you put in a little bit less amount every single year, but you just have a much longer time period over which you put it in. So let's take 8% a year. So I know on last episode, you and I talked about like what's a good return, what's an average return. Over the past 10 years, from 2011 to 2021, the stock market in America, the S&P 500, let's say, has been averaging around 10% per year, which is higher than historical, but it's 10%. So let's say you don't want to take that much risk. You want to go a little bit more conservative. Let's go 8%. And you should be able to, whether it's a mutual fund, whether it's your own self-directed fund, or whether it's real estate or whatever, you can go, 8% is a little bit ambitious, but you can get there. So let's say 8% per year is your growth rate. And the way to get to $1 million is 2020. In other words, $20,000 a year for 20 years.
The interesting thing about the stock market is I've heard that speech a lot. And I'm looking at the S&P 500 and I'm looking at the graph. And yes, it does go up over time. However, if you look at the graph of the S&P 500 on your phone or computer, you can see it. March 3rd, 2000. The S&P 500 was at 1400. If you scroll over all the way to like 2007, so from 2000 2007, it took a huge dip and it took 7 years to just get back where you were. So for 7 years, nothing happened. And then after 2007, it took another dip, and it wasn't until December 14th, 2012 that it got back to where it originally was. So from 2000 to 2012, if you had money in the S&P 500, it would have done nothing. It would have been completely flat. And actually, it would have taken dips. So you'd put the money in and it would dip. So you could try that dollar cost averaging where you're just putting in money and hoping it would go up. And yes, if you zoom out far enough over multiple decades, that would work out well for you. But what if you were towards the tail end of your career over that 15-year time frame and you just kept investing in the stock market and it was completely flat? It would just be a bad strategy.
Correct. Yeah. Timing has a lot to do with it. And that's why when you look at 20 years, yes, there's going to be some dips during those 20 years, right? And so some years your portfolio will go down. Other years it'll catch up and it'll do spectacularly well. But over a 20-year horizon, you cannot find a 20-year period where the stock market was lower at the end of the 20 years than at the beginning. So yes, there are dips, and you can find these dips over 2-3 years, sometimes 5-6 years, but not over 20.
Wait. I just went through this. So 2000, it was at 1400. It took until 2012. So it's 20 years. But if you go from the year 2000, and if you go 20 years out to the year 2020, yes, it did go up from 1500 to quite a bit.
Yep.
So yes, over time it did. But if you were in the retirement phase of that little window, but that's exactly why, like, I don't get me wrong, I put money in and I do the matching and everything with my 401k plan, but I think relying on it is not wise.
I agree. And a lot has to do with timing. You're right. If somebody retired in 2007, just before the housing market collapsed and the financial crisis hit, that was a really bad time to retire. Like, I think their retirement plans had to be adjusted big time. And so that's why many financial advisors will probably tell you that as you start getting into your 50s, you want to start moving away from all stocks and you want to start going into a little bit of bonds, a little bit of treasury notes, that kind of thing, that are not as volatile as the stock market, right? And so that will get you lower returns. You're not going to get your 8% anymore, but your downside is going to be a lot more capped. Like, you're not going to take as much risk on the downside.
But then in theory, then if you're moving away from those higher returns and you're assuming, say you had $1 million and you could just take the 7% out, then you can't really do that because you can only take like what do bonds give you?
Correct. It's whatever that portfolio gives you. So, I mean, bonds can give you like as low as 2% or 3% or 4%. And then you mix and match with some stocks and some bonds, depending on what kind of a return you want, right? The higher your return, the more risk you take. And you can kind of tune it to whatever risk you're comfortable with. But you're right. If your portfolio only gets 5% a year, then you only take out 50,000. And you can take out a little bit more if you don't want to keep the million, if you want to kind of burn down that stack of money. But I don't recommend that. But again, that's why I think most people will tell you 1 million is not enough to retire because, like you said, some things can happen. So you want to have a little bit of security. So it's like, yeah, try to push it to maybe 2 million and then you can comfortably retire and not have to worry too much about what happens in the stock market. But I guess what I want to talk a little bit more about is the 20,000 times 20, right? So $20,000 a year for 20 years. If you think about it, that's only $400,000 of your own money. The other $600,000 just comes from the compound interest from the market, right? That's your investment growing. So more than half of that 1 million is not money you put in. That's money that the investment generated. That's That's your
Assuming it's
investment return.
assuming it's going up.
Yes, of course. Yeah. And we talked last time about the 1%, right? How like some places will take a 1% fee
Mhm.
for managing your funds, whatever, right? And if you want to self-direct, you don't have to pay that fee. If you go with a mutual fund, sometimes they'll charge a 2% fee. That fee is very important. So just to give you an idea, let's say you put in $20,000 a year for 20 years. We talked about 8% being that theoretical 1 million. If you take 1% away and you want to get only 7% a year, you're only going to end up with 880,000. So you lose more than $100,000 right off the top over that 20-year span. So it might sound like a little bit, oh, it's just 1% a year, don't worry about it. But over 20 years and compound interest, it really adds up. And if you take another percent off and you only get 6%, right, you're going to end up with 780,000. So you're going to lose more than 200,000 bucks. So that the management fee really, really matters. And the longer you have it in there, some people have a fund for like 30, 35 years, right? You start working in your mid 20s, you have it for 35 years, you're 60 years old. That can be like hundreds of thousands of dollars if you're not careful. So you really want to keep an eye on that management fee. But let's say for a little bit that time is on your side and you're young and you got your head screwed on right and you're in your 20s and you say 20 years, I don't have to worry about 20 years. I got like a much longer time horizon, Chris. I can wait 30 years. So how much money do you think you need to put in every year if you have 30 years instead of 20 and you want to get to $1 million?
I don't know.
It's much less than 20. So it's only 8,000 a year, right?
Mm-hmm.
And so if I ask somebody the question, what's easier, $20,000 a year for 20 years or $8,000 a year for 30 years? It's obviously easier to do $8,000 a year for 30 years, right? Except a lot of people don't have 30 years because by the time they start investing, like for example, most of my investments didn't start until my late 30s. So I was a little bit late to that game. I don't really have 30 years. But if somebody's smart enough to do it, start in their 20s, time is really on their side.
Well, and depending on the type of job you have, I was in the middle of medical school and residency, so I had there's no way I had $8,000 laying around per year to invest. I had at best a couple $100 in my bank account at any given time. So I just didn't have that cushion to put any money in my 401k plan.
Right. And how old were you when you finished medical school and you were able to start working as a doctor?
So I started working, residency. So as a resident, I started making $35,000 a year. So for anyone who doesn't know, so you go to undergrad and then you go to medical school. So 4 years of undergrad, 4 years of medical school, and then residency is another 4 years. So during residency, I was making about $35,000 a year. So that's not a lot of cushion to invest at all. So I didn't start actually like working as a full physician until I was about 30.
Mm-hmm. Right. Yeah. And it's interesting. Like my situation is somewhat similar, although I'm not a doctor. But So I finished my undergrad in mechanical engineering. I started working as an engineer in the auto industry in Michigan, and then 2005, 6, 7 hit, and Michigan was hurting. Like Michigan was hurting years before the 2008 financial collapse. So right around 2005. The jobs started drying up. The annual raises started disappearing. They cut back hours, they cut back benefits, all that. Eventually, I got laid off in 2009, and then during that time, when 2005, 6 was the writing was on the wall. So I went back to school at night and on the weekends. That's when I got my business degree, and then I just went and did a completely different career. So I went into supply chain in the aerospace industry, and moved to a different town and all that. And so really, that's when I would say. I was 31 when I got that job in the aerospace industry. So that's kind of when I started first having a salary big enough where I could actually have a little bit of money set aside each month and start thinking about what to do with it.
Yeah, I'm sure it's great. In theory, you can invest when you're in your 20s, putting $8,000 a year. But I think the reality is most people in their 20s and early 30s, they don't have that amount of money to invest. And even people who are older, sometimes if you don't have the job or income that allows you to do it, it just doesn't happen.
Yeah. And that's why I think a lot of people who are able to, cohabitate with a partner who also has a full-time job, right? And that way you have double income coming in, you're sharing the cost of living and food. That's a great way. A lot of people just work on the weekends, like pick up an Uber, like Uber driving or DoorDash or some other side gig that you just do whenever you have time and whenever you feel like it, and you can pick up a couple $100 here, a couple $100 there. So there's a lot of things you can do, but you're right. A lot of people are in a difficult situation where they can't really just put any amount of money away. But just the way the numbers work out, time is your best friend. And
So go ahead.
no, I was just going to say, like, if you can start early, start early.
Well, and then you've spoken to me about this. Maybe now's a good time to bring up that example of the purchase for the Yankees.
Oh yeah, the purchase of the Yankees. Yeah. So, and just to show you, like, time can make any good investment look incredibly good. So, this is a pretty famous one. George Steinbrenner bought the Yankees for $10 million in 1973, and the Yankees are valued at $5 billion today, right? And so you see those numbers, like, oh my God, 10 million, and that investment is now worth 5 billion. It sounds super incredible, and it is. It's very impressive. But he had 48 years. Actually, if you want to look at it, it's almost 49, right? It's in the 49th year now of compounding. And if you actually work the numbers out, it's 13% per year is what that means. So if you invest $10,000, just take some zeros away, $10,000, and it can compound at 13% every single year. 49 years later, it'll be $5 million. In George Steinbrenner's case, it was 10 million to 5 billion, but the numbers work the same. And it's amazing, but the main reason why it's amazing is not because he was able to find the world's best investment. It's not the world's best investment. It's a good investment, but it's not the most amazing, whatever. The reason why it's so good is because it's 49 years, not 20, not 30.
Well, and of course, he started with $10 million. Not a lot of people. So $10 million now is still a lot of money. In 1973, that was a phenomenal amount of money.
It was, absolutely. Yeah. So, and again, if you're buying a sports franchise with cash, you probably don't need to buy it. You're buying it for fun, or you're buying it because it's
Yes.
a dream or whatever. But I'm sure he would have been okay even without that investment. So
Pretty much.
yeah.
So we talked about businesses. You did an MBA, and I'm sure you had a lot of case studies. So based on what you know, what would you say are the safest, and then what would you say are the riskiest businesses to invest in?
Businesses.
Yes. If you were going to start a business.
That's a great question. Yeah. I think the safest businesses to start are franchises because somebody else did all the hard work for you, right? So if you want to invest in a McDonald's or in a Starbucks, McDonald's and Starbucks, they have brilliant people on their staff, like thousands of really brilliant people figuring out the market research, the products, how to source the products, how much the products should cost, what kind of margins you have. And everything is there for you. It's like a little manual, like this is how you manage your store. This is how you manage your employees. This is what you pay them. This is how you do your taxes. This is what, and it's almost completely de-risked, right? Now, the one thing that I do want to say is that investing in a business is not the same as owning a business, because when you own a McDonald's franchise or Starbucks franchise, you're starting out, you actually have to work. Like, you're not just putting up your own money. Yes, you're doing that. You also have to put in your own time. Like, you're going to spend 40, 50 hours a week managing that location, at least for the first year or two, until you can find somebody to manage it for you and pay them. But so you're investing your time as well. And you should never think that your time is free. Your time is not free. Your time is valuable, and you're gonna have to work that in there. But if you don't know what to do with your money and you want to start a business, and like that's where you want to go. That's de-risked. If you are talking a pure investment, I'm always leery of companies that are highly regulated and companies that can't control their costs. A great example is airlines. Right? For some reason, like, I don't know why anybody in the right mind would start an airline. The amount of regulations that surround airplanes, safe operation of airplanes, safe maintenance of airplanes, what kind of pilots you can hire to fly those airplanes, and the amount of government regulation around airplanes is insane. It's probably the most regulated industry for good reason, right? I don't want to die in an air crash. But it's just a ton of government regulation, and your costs, you can't control your costs, right? You can't control how much the fuel costs, right? Like, jet fuel is whatever, it's driven by the cost of oil. You can't control that. Your staffing and your pilot costs are difficult to control because, yeah, you can negotiate with your pilots and you can negotiate with your flight attendants, but they're unionized, and you have to pay whatever your competitors pay, sometimes more. So you can't arbitrarily increase or decrease that. So there's all kinds of laws against, how much you can sell a ticket for, when you can give a refund, when you can't give a refund. It is extremely regulated. The profit margins tend to be thin. Like for every good year that airlines have, there's 2 or 3 bad years. Airlines go bankrupt all the time. It's ultra competitive. And yet, for some reason, every time an airline goes bankrupt, somebody else, some extremely rich company or investment firm will come and start a brand new one. I can't figure out why, but that to me is one of those where even if I was a billionaire, you would have a very hard time convincing me to start an airline. But yeah, like yeah.
Okay, so then ideally something where you can control your costs, probably a high profit margin, and less regulation. That way you have more leeway to run the business.
I would say so. As long as you have control of your costs, you're not too saddled by regulations, where there's a level playing field between you and your competitors. I mean, if you understand the industry and you understand the business, go for it, right?
Great. If you had to start a business tomorrow, what would it be?
Start a business?
If you had to start a business.
I have no idea. I don't think about starting businesses all that often. If I think for fun, if you want to start like just one of the first things I look at whenever I try to think about a business is how much money is it going to cost me to start the business? And most businesses fail. If it fails, how much money am I out, right? And that's why if you want to start, one thing I definitely, the other business I don't recommend anyone starting is your own restaurant, right? Like, yeah, franchise restaurants are good because somebody de-risked it for you. But if you want to start your own, like Chris's barbecue joint or something, right? Restaurants have a horrible failure rate. We're talking 80 or 90% of restaurants will close within the first year or two.
And why is that?
I think it's because a lot of people who dream about owning the restaurants, they might be good chefs or they might be chasing a dream, but they might not be good business people, right? Because yes, you might make the best ribs in town, Chris Ferguson, but when it comes to like the actual running the business, it's hiring the staff, firing the staff, training the staff, being there all the time, being there when the restaurant opens to make sure it's clean, being there when the restaurant closes at whatever midnight, make sure that's properly done, making sure that your customers get the rights. It's very hard work. Running a successful restaurant is a lot more work than a lot of aspiring chefs realize.
No, I think I've watched enough documentaries and I've known a few chefs, and it's a very, very difficult business. The profit margins are small. I don't know if like I'll go out and get a burger and fries and it's, I don't know, like $10. But if I had to go make that burger and fries at home, I don't know if it's that much more expensive to do it at home. I mean, it's a bit cheaper. It is cheaper to eat at home. It is healthier to eat at home, but I don't really, they still have to pay for the building. I think they have to pay for the staff and all the cooking stuff that they have to, cooking appliances they have to upgrade, I'm sure, and fix. They can't be making a lot of money on food.
No, and again, whatever money they make on food and drinks, it has to pay for everything, right? It has to pay for the rent, the equipment, the staff salaries, the taxes, the electricity. I mean, it's insane. It is, like you said, very thin profit margins if there are profit margins. Yeah.
Go ahead. What were you going to say?
No, I was going to switch topics to a different business idea. So if you have a restaurant-related thought, sorry, I didn't mean to interrupt.
Oh, no, I really don't. What were you going to talk about regarding business?
Yeah, because you were asking me like, what is a low-risk business to start? And getting back to our conversation in the previous episode, we talked about how today there's so much information that's free and it's available. And it's so easy to invest, whether it's starting a business or investing in the business or investing in real estate. I mean, you can do it all from the comfort of your own home, thanks to the internet. But one of the businesses that caught my eye a while ago is to start an Amazon business, right? Because now the way it works, and Amazon is making this super easy, right? Is you go to Alibaba, you start looking at what products are on Alibaba, you start emailing the Chinese companies and the Chinese distributors there, and you find a product and you check on Amazon. Okay, there aren't too many sellers on Amazon that are selling that product. It you know how much they cost because they usually cost 1/3 of whatever you see on Amazon. So if something's on sale for Amazon for like $20, it's usually 1/3 of that. So it's probably $6 or $7 that you can buy it for in China. And you open up an Amazon store and you just basically buy like 10,000 or 5,000 or even 1,000 of these little things. So let's say you find some $7 trinket from some Chinese manufacturer, $7,000. You just bought 1,000 of them. You pay a couple $100. You air freight it straight to the Amazon warehouse. Amazon keeps it in the Amazon warehouse, and then Amazon will just ship it out to whoever buys it. And Amazon takes their cut, like they take their fees and blah, blah, blah. And by the time you sell each one of those for $20, you might make a profit of $2 or $3, maybe $4 for each item you sell. And you never had to leave your home. All you had to do was just risk putting up that money. And the worst that can happen to you is nobody buys that thing. And then Amazon says, nobody's buying this thing. What do you want me to do with it? And you just say, you know what, chuck it in the garbage. And the worst that can happen to you is you lose that $7,000. The best thing that can happen to you is you start a successful Amazon business and you make money.
I think that's a very nice calculated risk.
Yeah, exactly. Your downside is completely capped. And then if it does work out, then you can grow it, right? You make back more money than you put in. Now you can buy more trinkets. You can buy 2 or 3 different kinds of trinkets, and it can snowball. And you know exactly what your risk is. You know what the upside is. There isn't a whole lot for you to do except to take that risk on and put the money up. And the rest is all about luck and elbow grease, right? And you need a little bit of both.
That is definitely something to think about. So, anything else you want to discuss on this podcast?
I'll give you one more low risk idea.
Okay, what's the low risk idea?
I'll put this in the show notes as well. It's so easy now. I'm going to repeat what I said in the previous episode and this episode. It's just so easy now to invest. Like these things didn't exist 10, 20 years ago. I came across this website called Fundrise. Fundrise. We'll put it in the show notes. And it's a crowdfunding website for real estate. So the idea is there's a company called Fundrise, and they buy like an apartment complex. And they have a business plan. It's like, here's the apartment complex we're buying. Like, here's the address. It's got like 20 apartments. And we're going to buy it for $1 million or whatever, $2 million. We're going to put in $500,000 of upgrades. It's going to be worth $3 million when it's done. And you can buy a share in that. Like, if you want to invest $100, you can invest $100. If you want to invest $10,000, you can invest $10,000. And they say, our expected return is like somewhere between 8% and 12%. We don't know yet, but that's what we estimate. And you get whatever we get, blah, blah, blah. And you can own a piece of that investment for whatever money you put up. And you can never lose more than what you put up. So you want to start with $100, you start with $100. You want to start with $1,000, you start with $1,000. Like, why not, right? It's a very easy, low risk way to get into real estate investing. And again, you don't even have to leave your house.
I think that's a perfect way to close out the podcast. And as a teaser for the next podcast, the next episode, what we'll do is we'll give some actual numbers because Gabe and I and my wife and his wife, we all went in and bought a property and renovated, and now it's rented. So we went through the whole process, and we will actually share the actual numbers of that property. And then we'll compare it to what like a stock investment or a real estate investment fund, et cetera, would do to see what our first investment is like. But we'll share the actual numbers with everyone on the next podcast.
Chris, that sounds like a plan. Looking forward to it.
Looking forward to it. Thank you for joining, everyone.
All right. Have a good one. Thanks. Bye.